Hi, welcome back to the channel. Now, in this week's stock market outlook, I'm going to walk through another high-level, broader market overview of the US stock market. I'm going to do things a little bit differently this week. I'm actually going to spend maybe just 5 minutes walking through the broader US market indexes, provide a little bit of an update to the market indexes charts that I talked about at the start of the month. But I've had a lot of requests for ETFs this year, and until now I've been really focused on growth stocks, the areas of the market that have been trending. So I've got a bunch of really great looking charts to add to your watch lists for the Christmas period. Hopefully, as always, the Scottish accent isn't too difficult to understand. It's taken a bunch of time to prepare, present, edit and upload this, so I hope you find a lot of value from my hard work. Please smash the like button. If you do follow me closely on X, like I know many of you do, hopefully my charts have helped you to navigate the last few weeks. It has been relatively tricky, especially across the technology space. But hopefully, I think overall, hopefully my work has helped you a bunch this year. Very few of us got on the record with the exact market bottom back in April, so hopefully you've had an incredible year as well. Now, for disclosure, myself or my clients may hold positions in some of the names mentioned, but I have highlighted those disclosures on the charts. Now, if you are a trader, an investor, a money manager or a financial advisor, you'll probably find a ton of value over the next 10-15 minutes. But as always, please do pause the video. Make sure you are comfortable with very, very important disclaimer before we kick on. Now, with that said, just a quick data point overview I think is a decent place to start. I think a lot of us have been watching the mega cap tech names and the technology names and wondering when they are going to rebound. Now, I am recording this just a couple of hours before the Friday session on the 19th of December. The market is currently in a little bit of a rally mode. I think we're all quite happy to see that, but over the course of the last few weeks, since we had the correction across the small caps, the micro caps, etc., rebounding spectacularly off the lows are many of the micro cap names. So throughout the month of December, month to date, micro caps have actually been showing the relative performance. The Dow Jones, as I'm sure we've all noticed, is now trading at all-time highs, whilst the triple Qs have lagged a little bit. Now, what I really like about the technology sector and the Qs lagging a little bit is, you'll probably observe it as well, is you'll get a lot of negative sentiment. You'll have the clowns of Wall Street announcing that all the mega cap tech names are done. And for me, as a buy low, sell high analyst, I absolutely love big pullbacks in tech, especially across the names that we all know and love. So I'm actually anticipating a violent rotation, I think, back into technology, hopefully over the Christmas period, early part of next month. So that's something very much to keep an eye on, because when we drill it down to the individual ETF performances over the last few weeks, very, very noticeable that there's been a clear pivot into more cyclical names. We can see that with the likes of the copper miners, the silver miners, metals and mining, gold miners, regional banks. A lot of the areas that have lagged a fair bit over the last few months have caught that bid. So, like I said, the big question I think I have over the next few weeks is, what are we going to get over this Christmas period? So S&P 500 I think is a great place to start. One of the charts, if you picked up my analysis at the start of the month, you'll know that the signal last month was the potential for a tradable market low. We had bearish week for the S&P 500, but within that, the individual components, there were a lot more stocks advancing than declining. So that's a pretty, noticeable buy the dip signal. Of course, hindsight shows us as well that there's a very strong support level around there at 650 now. Again, we've had the rebound, we're stalling out a little bit at all-time highs, but I actually think there are clues in the other indexes at the moment, and I'll get into that in just a little second. The longer term outlook that I have for the S&P 500 has not changed from picking up the exact bottom back in April. We have now met our upside targets in the S&P 500, so I would like to see confirmation of a breakout to new all-time highs to signal for me that the market is looking for higher prices. But like I said, I think there are clues across the other indexes at the moment. I think the NYSE composite, which is actually positive for the month, I think when I checked earlier on this morning, the NYSE composite was up around 1% for the month of December. So it's very, very difficult to buy into the perma-bearish narrative. I think, yes, it has been very, very frustrating across many of the technology names. But I think, broadly speaking, I think it's just been a healthy rotation. The Russell 3000 is in a range at the moment, which again, Russell 3000, you can use this chart or you can use the S&P 500. There's obviously a very, very strong correlation. But I think if we can get a breakout in the Russell 3000, the S&P 500, I can see the triple Qs have caught a bid today as well. So there's a lot of positives to take at the moment. The Dow Jones as well is pushing up against new all-time highs also. But like I said, the interesting aspect for me is the risk-on attitude since the correction that we had a couple of months ago in the Russell 2000. Again, it's pushing up against new all-time highs. I think as long as you're above those 2021 crash levels, I think we're absolutely fine. The micro caps, I think the same message. There has been a little bit of a wobble this week in the micro caps. It has pulled back to support levels dating back to previous highs and dating back to 2021. But the hope is that if we do get all of the indexes breaking out simultaneously, hopefully that just further signals that it's more prudent to buy stocks than it is to short stocks. Now, just to be clear, that doesn't mean I don't understand when to look to start to get defensive. I think if we start to see failed breakouts, I think in the micro caps, the Dow, etc., then that would be a valid signal to think about tightening up stop losses, weighing up the riskiest stocks, and figuring out, I think, what you want to hold in a downturn and what you want to get rid of. I think that's the game that we all play. But the VIX, it's very, very difficult for me to present a bearish argument when the VIX is still being suppressed. It's pushing 15 at the moment. So I think the signals that I certainly work with leads me more down the road of we're hopefully going to see the Santa Claus rally that we all want to see. I think we all hope for. But like I said, just have one eye on the other side, just in case these charts do put in massive tops. I would always urge anybody to have some kind of plan in place in case the market has a bit of a downturn. Now, a couple of areas of the market that I just want to provide updates on before I get into ETFs and stocks that I have prepared that are aligned with those ETFs. But gold, my outlook, my chart has not changed. I think when I look at the metals and mining areas of the market, commodities, etc., you are starting to see a little bit of froth up here. Now, gold at the moment is obviously touching on 4,300. My longer term outlook is up towards 5,000. Very, very difficult to justify, in my view, buying new positions in either gold or silver. I actually had one of my clients this week asking me what I thought about silver moving above this 65 level, and whether or not potentially that this could be a decent entry point. I find it very, very difficult as someone who gravitates more towards buy low, sell high technical analysis, and I'm looking for structural trends. I find it very, very difficult to justify or present charts for new entries when something has already moved 50, 100, 200%. For me, that doesn't make a lot of sense. I'm sure for many of you watching, especially if you manage money, that will absolutely resonate. So I find it very, very difficult to recommend buying silver up here. If other folks want to buy silver and keep driving the price higher, happy days. But at the moment, we've met our upside targets for silver. These are Fibonacci levels dating back to 1980. I'm not expecting anybody watching this to, understand the chart or understand what Fibonacci levels are, etc. But for some reason, the market just gravitates towards them. As a professional analyst, I obviously, zoom out 10,000 foot view, and for me, I can see that the Fibonacci extensions from 1980 have merit for this particular chart. So for me, silver has met upside targets. If it keeps going, great, but new entries, I think, very, very difficult. Now, with that said, I'm about to walk through all of the ETFs, the stocks. I think most of you will be used to by now a lot of fancy graphics, etc., that accompany a lot of the stock selections. I'm actually pressed for time a little bit this evening. Have a Christmas dinner in an hour or so, but where I want to kind of start is with the steel index. Now, steel index, massive 14-year cup and handle pattern. Now, there's obviously previous all-time highs dating back to 2008. So if you are someone who is looking for ETFs that have a little bit of leg room to keep moving higher, the steel index would make a lot of sense. Certainly just bullish above 75, maybe not so bullish if we do get a little bit of a downturn and dip below those levels. There's also a 12-month consolidation that's been developing within insurance. Now, listen, I get it, insurance, it's not the most exciting, it's not the sexiest area of the market, but there are some really terrific stocks in there that do have high short interest, etc. as well. I think I have prepared it. Now, I'll get into it in a little second, but that's a 12-month base in insurance that looks to be developing, and obviously if it does break out and confirm a breakout, then potentially that could be an area to look at. Now, retail has been beaten down a lot over the last few months. It has caught a rebound, I think, over the last month. Some of you will have picked up some of the retail names that I've been putting out to social media, the charts that I've posted on X, for example. So I'm actually starting to look at retail potentially if it can break out above these levels. I think there's a decent amount of upside for retail, the ETF. I think those of us that look for alpha, though, are obviously looking for the strongest stocks, or the stocks with the highest upside within the ETFs. But certainly XRT might make some sense there. We've got consumer discretionary. Now, please be aware there's a massive component of Tesla within this one. I think it's Tesla and Amazon make up, I think, 45% of the actual ETF. So, just bear that in mind if you are tempted by the chart. It does look like it's potentially trying to put out a breakout, but I get it. Most of you will prefer owning Amazon or Tesla. The Mag 7 stocks as well, I think we are potentially basing. Now, just again, for complete transparency, got in our clients at the absolute bottom back in April, and it's been on a massive run since then. and yeah, potentially it could break out again. I'm using Fibonacci levels here because I can see from this particular chart that Fibonacci levels matter. One thing to say, and that's why professional analysts exist, it's not every chart you can use the same tools. So for this chart I might be using Fibonacci extensions. Other charts you might find I'm just using basic support and resistance, or maybe a moving average or something. I've been banging the drum all over social media, platinum, over the last few months, and of course it just keeps ripping higher. Now, what I will say is, I think it's the same message with silver, I think with platinum. Again, it's one of our ETF picks. It's just been ridiculous. Keeps motoring through the levels. I think when you're buying up here, it becomes very, very difficult. There is unbelievable volume that's been piling into platinum over the last few months. It is breaking out again above key levels, but I think given the nature of the chart, you're probably looking for some kind of meaningful pullback, potentially into the 17 level, if you are someone who is looking for optimal entry points. Like I am, for example, when you get a breakout here, that's an optimal entry point. If you get a breakout here, that's an optimal entry point. I think you get the idea. So platinum, same with European financials. Again, using Fibonacci extensions from the 2019 declines. And again, longer term outlook, monthly chart, looks like there's a fair bit of upside potentially there. Palladium, another one that I've been banging the drum on all year, and since it was forming this base. I think I started to tout it on social media and X way back at $90, and it's just been absolutely ripping higher. The upside objectives here are up around 275, 280, but again, probably due a little bit of a breather in the near term, and I think any weakness will hopefully offer some kind of opportunity. And also regional banks, again, Fibonacci levels dating back to the COVID crash, we can see that they have merit. Strong support levels have held up over the last couple of months, very, very pleasing to see, and potentially back to all-time highs up towards 80 would be a logical target to aim for. Now, I did say that I had some individual stocks that were aligned with these specific ETFs that I wanted to present. I think Steel Dynamics, if you're looking for something within the steel index, I understand that ETFs aren't for everyone. So potentially the steel dynamics might make some sense there for you. We've got Lemonade now. I did say about the insurance names, they're not the sexiest. 20% short interest with Lemonade, and potentially it could be poised to break out over the next few weeks. Again, chart we've been bullish on for a few months. Estee Lauder, again, going back to kind of the retail consumer discretionary, I think there's potential there that we're dealing with a tradable low. These are AVWAP levels dating back to 2009. Now again, I'm not expecting anybody here to pick up on these types of tools and obviously take the time to figure out what works. But like I said, that's why professional analysts exist, and yeah, potentially there could be something there for Estee Lauder. Lululemon, again, chart that I've been posting about on social media over the last few weeks as a buy low, sell high opportunity. It's up, I think, 15-20% off its recent lows. The target that we're working with there is up around 255. I think there's been a little bit of a pullback across some of the retail names because Nike have reported earnings in the last 24 hours. It's kind of spooked the market a little bit, but Lululemon have already reported their earnings. Nothing wrong with them. So I'm looking for our first target there up around 255. Hopefully that will be met over the coming couple of months. Target, another retail name. Again, it's one of those buy low, sell high charts that I like. It's pulled into levels dating back to 2018 and also the COVID crash. So again, if you've missed the entry down around 90, I think the next one would present itself, maybe a base breakout above 110. UPS, again, dating back to 2004, very, very strong level. Now, what I love about buy low, sell high technical analysis is it doesn't have to be too complicated. You obviously find strong stocks, UPS, been around forever. I like little shakeouts at new lows, and then oftentimes what you find is you kind of get the start of a move higher. Now, thankfully, that thesis has played out over the last couple of months. I think quite a few of our clients have jumped into UPS at these lows, but obviously risk management is paramount. If you have bought the lows here, I would always urge you, get your entry position at 90, and then once it moves 10-15%, stick a stop loss on it so that you don't lose money. So that's the way that I would be treating UPS at the moment. Abercrombie and Fitch as well. Going back to kind of the retail names, that looks like a compelling double bottom chart pattern there. There's a couple of targets that we're working with there. Obviously with Abercrombie and Fitch, there is a 12% short interest as well. If you are looking for something in technology, semiconductors, then Taiwan Semiconductors might be appealing. Again, very, very clean chart to manage risk against. I think if there's a breakout above $315, then potentially it could take the next leg higher. Taiwan Semi, AMD, Nvidia, these are all charts that I tend to provide coverage on most of the time. Speaking of Nvidia, I have been watching this with a lot of interest, hoping that it would pull back to this kind of 150 area. Doesn't look like we're getting it. I think that this might be as low as the stock goes. So certainly, just for complete transparency, I did put out a high conviction idea to our clients in the tech space this morning. And so I do have a little bit of conviction in semiconductors and technology as a buy the dip candidate. So if you are in there, I think 210, taking it back to previous all-time highs, might make some sense there. And also Microsoft, going back to the tech space, is down around 15.5%. From its recent all-time highs. It's pulled into these July highs, which offered a breakout opportunity earlier on in the year. It's pulled back to logical levels. I think, just as a general note, I think the OpenAI shenanigans has kind of spooked the market a little bit. I was actually hit with a position I had in Oracle. I decided to buy the dip in Oracle a couple of months ago, and that position got absolutely bulldozered due to the market pullback across tech, but also anything that has kind of any exposure to OpenAI just seemed to get hit harder than anything else. But again, I think as long as you're above these levels, I think the dip is fair game to be bought in Microsoft as well. Now, one thing I did want to touch on as well is I do have a little bit of an announcement. For those of you that follow me closely across social media, etc., you'll know that from time to time I like to throw out little offers. Christmas, lots of you have been asking, so I put out a promo for Christmas. There's 20% off all of our memberships, so feel free to check that out. If you are new around here and you're wondering who it is I am and what it is I do, there is a link in the description, and it'll take you through to our website at honeystocks.com. Now, one thing to say is I only use my own custom charts and data. I can't emphasize that enough. But we do provide memberships to all of our premium work, and what our memberships provide is access to our premium weekend analysis that we put out to our clients and members every single weekend. Provide access to all of our highest conviction investment ideas. I will show you what that looks like in just a second. I also put out a midweek halftime analysis a couple of times a month as well. Provides all of recent updates in areas of focus. We also provide access to a wonderful community of highly intelligent professionals, investors and traders from all across the world. You also get access to all of my charts, so all of my ETFs, my chart books, my trade ideas, that's all covered, as well as commodities. And if you are someone who is perhaps new to technical analysis and investing, etc., and you kind of want to learn a bit, I also provide access to our technical analysis program, which I used to charge a lot of money for, but now I just include it free of charge within all of our memberships. But just to show you what our timestamps and high conviction ideas look like, as you'll see from the charts, I do like to keep things very, very clean. You've probably noticed that already. It's maybe why you follow the channel. Very, very clear instructions on the charts. Cipher mining, again, terrific. Nebius, terrific. Not so terrific recently, but great ideas. SoFi, again, monster gainer. AMD, which was the exact lows earlier on this year. Palantir, which has been a monster over the last couple of years for us, and also Nvidia as well. But I am very, very unique in what I do. I publish on my website, for complete transparency, all of the highest conviction ideas that I put out to our clients. I show the performance of those ideas. So feel free to go and check that out. I have done this for the last 7-8 years. Every single year I log the performance. Obviously a lot of alpha within that as well, but please do make sure that the types of stocks that I like to recommend are the types of stocks that you like to buy. I'm not looking to take excessive risk with penny stocks or stocks that just don't have the fundamentals behind them, etc. I do have a fundamental overlay to a lot of my work, but yeah, feel free to go and scrutinise that and see if my work is a good fit for you. But I think just on a more general note, I think my work is generally a good fit for you if you are someone who has a mid-term approach. If you're looking weeks to months out, maybe you keep getting shaken out by market news. I think if you keep missing tradable market bottoms or when to get defensive, maybe you keep getting confused by all the different analyst opinions. Maybe you want to be part of a successful community because you're sick of hunting around social media. Maybe you're just too busy with work, business, family, etc. to find the best stocks and charts. I think that's maybe where professionals come in. And again, I would encourage you, if you are someone who's maybe new to technical analysis, I've really built out a great program as well. So if you are someone who's looking to learn, I think you might be a good fit as well. But like I said, link in the description, 20% discount over the Christmas period. Feel free to check it out. But if you have stuck here to the bitter end, I hope you have a wonderful Christmas period if you celebrate Christmas. If not, please enjoy the downtime, and I'll see you next year sometime. Thank you very much.